Welcome, everybody. Glad that you could join us today. This is Kim Arthur, CEO, CIO of Main Management, and I'm joined with my newly printed partner, James Maxwell, Senior VP of Research. James, how are we doing today?
Great to be here. Happy Q1.
Yeah, definitely happy Q1. Congratulations on being made a partner at Main Management at the end of last year. That is awesome.
A
So
huge
glad to
honor.
have it.
Yeah, thank you.
Great. So I thought today we would go through the first quarter 26, our macro outlook, and see if we can shed some light on our great partners. In fact, want to make sure we give a shout out to all the partnerships that we so much value. So thank you guys for your time, commitment, and trust that you put in us. So just a quick overview, quickly. We are a San Francisco-based partner-owned RIA. We're 5.1 billion, of which 10+% is partners' money. We have 27 team members. Half of those have equity. And again, we like being out here in San Francisco, which is kind of the heart of innovation. So we encourage any of you guys to come out and see us. The 5-person IC team that we have here, I want to point out that 60% of these team members have been with us since the inception of the firm. So the results you see that have been produced on the field, 60% of them and have been there from the inception. And then we've augmented it with our head of research, Alex Varner, and then the managing partner, Daryl Ryan. And then just quickly, cost, trust, price and proof, and time in the market. Those are our 4 kind of firmly held beliefs that we have. And those complement the culture that we have inside the firm, which is client first with exceptional service. So with that, James, let's jump into, why don't you give us a little overview here on the asset class and sector performance?
Yeah, I think starting out high level for 2025, the biggest takeaway that I can see from this is obviously international led the way. You saw EM equity, EFA equity up at the top there, above 30% for the year, above S&P as well at 18 or right around 18. That's the first year of outperformance, at least significant outperformance in a long time.
That was a long time coming.
Yeah. And it's, I think, one of those things that we've been talking about for a number of quarters now, where a lot of advisors, a lot of investors are underweight that asset class, and that's felt good for the past 10 or so years. And now it's kind of the question mark arises of, oh, is this an entire 40% of the equity market that I'm not having exposure to? Is that worth taking a look at? And certainly we think that there's at least a conversation to be had, given the kind of widespread, a complete absence of any sort of investment in that asset class.
But what surprises me, it doesn't surprise me, but the scoreboard was exceedingly good, right? You look at the worst performing asset was up 4%.
Yeah.
And the top at 34. But boy, during the year and particularly in April, people thought that the bottom was falling out.
Yep.
So that's sometimes, I like that feature because that means that, bulls like to climb the proverbial wall of worry.
On the sector side here, I think it makes a lot of sense if you've been listening to any sort of market narrative over the past year. What's been leading? It's your communication services and your information technology, 2 of those kind of growth AI focused sectors. You're getting exposure to your Googles and your Nvidias, and also all those companies underneath them. Those obviously have led the way and led the S&P to highs. One thing I want to flag as well, for the fourth quarter on that right-hand column there, you can see healthcare stood out at up almost 12% during the quarter. That almost was its entire full year return just during that fourth quarter. I'll say on healthcare specifically, it's had its troubles, it's had its issues, a number of kind of question marks around it. The valuations and sentiment really, really came down during the year. And that fourth quarter was a bit of the rubber band swinging back, where you had all this kind of pent up poor sentiment, lower valuations. Then as soon as you saw like the first signs of positive news, it really swung back in the other direction.
Sounds like a perfect example of price and proof.
Exactly.
All right, so this is the Federal Reserve Fed Funds Futures which if you look at this it shows them actually going down to 3.1% by the year end of 2027. But for this year, I just looked at it before coming in here. There's only one rate cut priced in. That's in September. And that keeps moving out there. That was kind of May, then it was June. And that is a result of the fact that GDP, which probably just ended 2025 at 3+%, is going to be around that number here in 2026. The 2-year, which I like to look at, we call it Mr. Fed, real time Fed, is now at 3.62. That equals zero rate cuts, which is probably the right number. But the Fed funds futures, they'll do what they do. This is a piece that is exceedingly bullish for 2026, and it's a result of the one big beautiful bill last July. The 100% capital expenditure expensing effectively gives you a 10% corporate tax rate. There were some glitches that it looked like it was only going to be 15%, but Secretary Bessent had the ability to kind of like wave his magic wand and get it down to 10%, which is where it should be. So that is a big tailwind. And then you're going to get a one-time bump here. A lot of it here in the first quarter, where a lot of people will get tax refunds on the magnitude of $200 billion because they didn't have to pay taxes for the lower income in Social Security, car loan expenses, tips. So a lot of these things are very stimulative.
So you mentioned the kind of monetary policy tailwinds, the fiscal policy tailwinds. One of the other huge stories this year was, obviously, I mentioned it earlier, the AI spending, the AI build out. This is a chart looking at the kind of 5 major hyperscalers, as they call them: Amazon, Google, Meta, Microsoft, and Oracle, and how much they're spending on their capital expenditures. You can look back at 2020, 2021. It was kind of roughly around a normalized amount, 100 billion or so. If you looking forward at 2026, 2027, 2028, you're reaching a run rate of over 500 billion estimated a year, exploding in sort of cost there. And one of the things that we're thinking about is, where is all this money flowing? Obviously, the first derivative is your semiconductors, your wiring in the data centers, the steel, whatever they need to kind of put all that together. There's also the second derivative, where it's, okay, who's going to benefit from all of this build out? Why are they even building it out? It's very much to support, building out this AI. Who's actually going to benefit from AI? It's companies that can use it. So it's, things like that come to mind are risk and analytics and financials. Within healthcare, it's drug discovery, or, more efficient processes in that very regulated industry. That's where we're kind of focused on where that puck is going.
Yeah, it's amazing. Some people have said that, probably in 25, the, what is it, 400 billion that was spent, it was probably 1+ point of GDP, which is true, but it also means that there was still another 2 points of GDP.
Yeah.
So
Yeah. It's not the only thing, but it's certainly a big driver.
big time.
On the labor market here, you've kind of continued to see some softening. I mean, just looking at the chart, this is of non-farm payrolls. You can see that green line steadily come down since kind of the very hot environment of 2022. In our view, there's kind of a couple factors that make this look less bad than it might look on the surface. For one is the reduced immigration, where basically you have just less supply coming into the labor market. So you need kind of a lower run rate in order to keep that kind of break even. We estimate that it's right around 25,000 at that kind of break even run rate, versus just a year or so ago, it was closer to 100,000 that you needed to kind of maintain the same unemployment rate. That's something that's kind of just a natural result of less immigration.
Yeah, sense. So this one on the youth unemployment, I have a little different take that's probably a little less conventional, but hear me out here. The circle piece that you show here, for those of you that can't see, it's a 20 to 24-year-old cohort. So it's basically the college kids. And if you look at the long sweep over 25 years, it's currently 8.2%, which alarm bells go off because it is well above the 4.4% total. And then people see, kind of coincidentally with the launch of Chat GPT, it looks like it went from 5.5 to 8.2. But again, if you spread this out and you look at over 25 years, the average over that time, clipping even the peaks, is over 10%. So you're below the average. And I would argue, here's my unconventional piece here. COVID really damaged the college kids. College kids had no adult supervision during college, during COVID. And what it meant is when they graduated, they were not prepared for the big leagues, not prepared at all for the big leagues, for the structure, the commitment, the grit. And that changed dramatically. We hire a lot of young kids out of college here, and that changed dramatically with the class of 24 and 25, really 25. So I'm bullish, and I think that actually this is not just all AI related. I think it was people not being prepared. COVID was a huge, huge wet blanket. That's my thesis, and I'm sticking with it.
I think there's a good point there where COVID, you can obviously look at the spike in the unemployment rate in 2020 or April of 2020. That's the kind of obvious effect, but you continue to see these kind of long lasting waves of data distortions, all sorts of distortions down the line, which makes sense if you shut down an economy for however many months, you're going to have issues down the line, or just even things that you can still see down the line as a result of that.
So true. So true. Now, on the labor market outlook, there's a couple things that are more of leading indicators to look at. First of all, talking about what happened in 25, there were about 250,000 government jobs that were taken out of the system. Actually, a lot of those have moved into, they either retired completely or they've moved into the private sector. We all know this is not negotiable here. Is the private sector productivity is significantly higher than the government. So those people, there's actually cases of people leaving the government, going into private sector, getting paid more and being more productive. But my point is that the 250,000 jobs were kind of a one-time headwind in 2025. But the panel on the right here looks at United States business applications. Those are nearing an all-time high, approaching 500,000. That's over 2 times pre-COVID numbers. Those people will be at least one person they employ, and they may start to grow themselves into small businesses that hire more. So that to me is a huge leading indicator that things are very robust under the cover.
On inflation, obviously that we talked about the labor market, one side of the Fed's focus. The other side is, of course, inflation. You kind of continued to see it moderating around 2.5 to 3%. It's been at this level for a number of months now, even maybe even over a year. What I think our view is that coming into the year, there was a lot of fear that tariffs would show up in those inflation readings, and you didn't really see that ever really show up on the headline. If you look under the covers, there's some items that got tariffed that the prices went up as a result. But oftentimes, what you can see in the way that we think about it is tariffs are like a tax, where it's going to, if someone's spending more on the vegetables that they're importing from Mexico, they're going to be spending less on maybe the haircut that they're having down the street, or the shirt that they're buying that's made here in the US. So it's kind of overall the pie of spending is remaining somewhat steady. But the pieces under the covers might be moving kind of as they naturally do.
Yep. It's a great point. Great point.
On the drivers of inflation, one thing that we've been keeping an eye on is oil prices. They've been steadily moving down over the past year, and then you obviously had this spike in the past month or so with a lot of the geopolitical news that's come out. But I think overall the narrative is oil is obviously a key input for a lot of goods and can really be a bad input for inflation. Saw that in 2022 with the Russia and Ukraine war. That obviously spiked up oil, led a lot of goods down the road to being more expensive. The oil as an input right now doesn't really have that same pressure. So that's one of the things that's like hard to see pressure from, at least is the input prices.
Yeah, if you wanted to win a bar bet, 1973, the Yom Kippur War, that was first oil embargo here in the U.S., and people that are old enough to remember, they sat in car lines, gas lines for hours and hours. The globe at that time was 85% fueled on hydrocarbons. Today, it's
Mhm.
85%. So again, you can win a bar bet for as much as people, want to look at other alternatives. They are slow moving.
Yep. On labor inflation here, this is the unit labor cost is a measure that looks at basically how much does it cost to have an input of labor in the overall economy. So it's a very much like an economist type of measure. It's looking through. It's not something that's like kind of hard and that you could really feel, but it's something that is kind of a residual from a calculation overall in GDP in productivity, basically wages adjusted for productivity. The way that we look at it is it's been coming down now for a number of quarters. It's way below its peak in 2022. And it's a measure of kind of how much labor costs are pressuring the overall inflation rate. And because basically what you've seen is productivity stepping up, people are being, more productive with their work. There's more output per hour of work. What that allows for is the GDP to remain robust, and we'll talk about GDP soon. Um, while the actual input costs remain kind of somewhat lower, or at least growing at a lower rate. So that's an overall positive. Obviously, productivity is very strong, and is a strong input for the economy. But this is one of those things where looking at inflation drivers, you don't see it really in oil, you don't see it in the labor market. It's hard to see a lot of things that are pressuring inflation to go higher from here.
And this is bullish, obviously, for corporate margins and the fact that we still have real wages that are north of 1%, which is trend line. It means that people are still having real wages, but
Hmm.
then corporations are winning too. It's a win-win. All right, productivity. You started to talk a little bit about that. I like to look at productivity over a long sweep of time, and this is obviously the picture you've got is a long sweep. 1860 is the start point for people that are just listening on audio here. But typically, productivity runs between 0 and 4%. And you could probably clip it more like a little below 1 and 4%. But you need a technology cycle or some sort of drivers. And as you
Hmm.
point out in here, you had factory electrification at the turn of the 20th century. That was also a period where we went from 0.5% GDP to 3%
Hmm.
for the next century in the 20th century. That was a five-fold increase. And then you show mass production of World War II innovations got you up to over 4%. And then the most recent one, people remember back in the 90s, the internet got you up to 4%. And we're in the middle of this AI here where we're only at 2+% right now, but we think it's going to do exactly what it's done before. And it's going to drive its way up to 4. And it might even go above that because most people would say that AI is way more impactful than any of these previous ones. Go ahead. What do we got there on
Yeah.
GDP?
On GDP, we actually just got the latest report today. This fourth quarter, or sorry, the third quarter of 2025 came in at 4.4%, the highest rate in 2 years. I think this continues to show the economy just chugging along, driven by not just, as you alluded to earlier, the kind of AI build out. We like to look at under the covers, you can see what the drivers were. The largest component of GDP is consumer spending, and that was up 3.5% on an annualized basis. So continually, consumers are continuing to spend at a kind of high rate. It's not just kind of there's some narratives that it's just the AI boom, and that's certainly not the case that we see.
Interesting. Okay. This picture is the fourth year of a bull market, which we started in October of last year. What's interesting about it, it typically is one of the, except for the start of the bull market, it's a high teens type of return with much lower drawdowns. The drawdowns are only 8%. So if you kind of use the start point in October of 25, that gets you up to about 7,600, which is where a lot of analysts forecast are for this year. Now, the drawdown will be interesting because the fourth year will end just before the midterm elections, and we'll probably have some volatility around the midterm elections. If what historically happens, the House and the Senate will lose seats as they historically do. But I think the feature to keep in mind: lower drawdowns. We've also even filtered this down lower. If you look in bull markets during the election years, the drawdowns are only 5%. So you could have fewer drawdowns until the back end of the year.
Moving on to mortgage rates and kind of the housing market here. Obviously, this has been something that's been struggling for a number of years. It's been really constrained by higher mortgage rates. I think we're starting to see some of the light at the end of the tunnel. Obviously, mortgage rates just on the headline are at their lowest in a number of years. You saw that peak at almost 8% in 2023, 2024. We're now at kind of low sixes. One of the things that we've been looking at is because purely there's just been a number of years with high mortgage rates, more and more people are moving to like above 6% mortgages. There's actually more mortgages now above 6%
Oh,
than below 3% or 3 or below percent, which basically to us shows that there's overall less of this opportunity cost issue. That'll continue to be a thing where before a couple of years ago, everyone had their 3% mortgage. It was very, very hard to say, okay, I'm going to go from 3 to 7%. But now it's okay. Maybe, people that bought a house a couple of years ago, they're at 6%. It's more reasonable to say, okay, I'm going to stay at 6% and move to a different house, which obviously is a positive for the housing market. I think there's, broadly still it's struggling and there are issues to work through there. Um, but it's a positive sign that it's coming down.
definitely. One other thing that I would add is the administration has been very focused on trying to control mortgage rates.
Mhm.
That's a tough task because they're priced off the 10-year, and the
Yep.
10-year is way bigger than what they can do.
Yep.
But Ken Griffin from Citadel made a very interesting observation and something that the administration could put into place, and that is Freddie and Fannie basically buy the conforming mortgages. And he said, since we have a supply issue, that's one of the big things that you could go after is the supply. We need more single family homes. And he's like, why wouldn't you tell Freddie and Fannie they can only buy mortgages in zip codes that have very favorable regulations that allow more construction, not less construction? That is something that the administration could definitely put into place and they would have control over it, where the 10-year is a lot more
Yeah.
difficult.
Speaking of the 10-year, this is
Yep.
a chart that looks at the spread between mortgage rates and the 10-year yield. And you can see for 2023, 2024, that spread was very high. It's come back in now where it's closer to that kind of long-term median. Usually it's around 2% between the mortgage rates and what the 10-year is. But yeah, as you mentioned, that's something that's harder to squeeze. You're not going to force the 10-year. It's very hard to force the 10-year down as an administration. You have to focus more on kind of maybe things that pass through Congress or other measures, other ways to increase affordability other than trying to squeeze that rate down.
Yeah, so true. All right, flipping to the dollar goes through cycles, and if we had even a longer dated picture on here, you could see it ebbs and it flows. Last year, it was very weak against the developed markets. It dropped 10% in the first quarter, which was very, had a lot of compounding issues around it there. But against emerging markets, the dollar was actually stronger. I think looking at the dollar, our kind of house view is that it's going to be stable against the developed markets, but you're going to lose against the emerging markets, which is another great tailwind for being long international markets because you're going to have an extra currency
Mhm.
tailwind. And speaking of that, this is a great picture going back to the 70s that shows, like a lot of asset classes, you get these cycles where they're in favor and out of favor. And historically, when they've been in favor, we've got four of them circled there to the left. It's a 3 to 5 year process. We're only just starting year two right now, and people are clearly underweight. And you get the added benefit that you'll see here in a minute. It's an asset class trading at 15 times, not 22 times like the S&P. It should trade at a discount. Its closest proximity would be large cap value, which is 19 times. But those two should trade at about the same. So you get a multiple expansion plus the earnings that we'll see here in the next slide. Here we've got a picture of what the earnings broken out for the emerging and the developed, emergings in dark blue, developed in green for last year, this year, and next year. And the middle one shows the emerging markets are 20% growth. So if you get a currency kicker, 20% growth, and a low starting PE, that sounds like a trifecta that you want to be involved in an asset class that people, for good reasons, for a dozen years it underperformed and they said, I don't want international, but they will begin to have it.
Staying on earnings, this time kind of moving back to the US and the S&P 500, you've continued to see very, very strong earnings growth domestically. What I want to focus on is that dark blue line right in the middle there,
Mhm.
that next 12-month earnings growth line. You've you've seen throughout 2025 and now moving into 2026, it just has marched higher, where we're now at 14.7% expected earnings growth over the next year. That's very, very strong. It's one of the highest readings uh, in the over the past year plus. What that is, and basically how we view it is earnings supports equity valuations. You have to see those earnings continuing to move up. Something we always harp on. It's something we're watching, we're looking for, and that is a positive overall for the markets.
Yeah, that's powerful.
On the recession dashboard, we recently moved two blue, previously things that were blue to green, those being inflation. I think broadly talking about that, we talked about it earlier. There's a lot of lack of pressure upwards on inflation. We talked about oil prices. We talked about unit labor costs. Overall, we see inflation just continuing to kind of moderate here. It's going to be, a slow grind down, down as it's been for a number of years, but there's not a lot that's pushing that inflation rate upwards. On the yield curve, that's another thing we're watching as a positive. You continue to see this kind of steepening of the yield curve. The Fed's are expected to maybe cut rates one or two times during 2026, and overall just a normalization of the yield curve away from it being inverted 2 years ago or 18 months ago.
I would say looking at that, if I had to make a bar bet here, I would think that the consumer would be the next one that we would probably flip um, back to green. And obviously, the terrorists, we've kind of gotten through it, so they have easier comps that'll be
Mhm.
coming up here, which is always a good thing. But yeah, that's very, very constructive.
Lastly, on our kind of outlook, and Kim, you can touch on this
Yep.
as well. Just from a high level, we're looking at the out year of earnings. So in this case, it would be 2027 earnings. That would be right around $350 expected
Yep.
for that total S&P earnings figure. And for our upside, that's 21 and a half times would imply around a $7,500 price target. On the downside price target, 18 and a half times multiple, implying 6,500 on the low end.
Yeah, and I would just point out two things. I always like to find markets where you have a 2-to-1 upside. So we're 6,900 as we're doing this recording. So if I look to 7,500, including the dividend, the total return is about plus 10%. And the downside, again, including the dividend to it, to 6,500 would be about 4.5. So I've got a 2-to-1 upside to downside. I like that entry point. And I also like to point out that the 21.5 multiple is actually a slight discount
Hmm.
to the start of 25 was actually closer to 22 times. The start of this year was closer to, 22 times. So we're actually having a little bit of a multiple contraction, which it's all on the earnings, which is very, very powerful and what you need in the middle of bull markets.
Exactly.
All right, I think that's all we have. So, James, as always, it's always great to get the insights from you and your research team. You guys do an incredible job. And again, I want to give a shout out to our most valued people, which are you, the advisors. You are, without you guys, we don't have a business. And anything that we can do, we like to say it's two rings, no waiting.
Hmm.
James, anything else for
No,
the
thank you, and thanks for all the time. And if there's any questions, feel free to reach out.
awesome? Thank you guys very much.